Hello and welcome to the first of a two-part series videos on the cost of capital. The first one will be a primer of the theory. Just to give you an idea, this is where we are in our travels. We're talking about the weighted average cost of capital, which is nothing but the discount rate at which we're going to evaluate our cash flows. Weights are for debt, preferred stock, or common stock. As you can see here, the cost of debt go into this formula, and there are going to be two kinds of factors affecting this cost. Some of them are going to be unrelated to the company or uncontrollable, like market interest rates or market risk aversion, and on the other hand, we'll have things that the company can control, like the debt equity mix or how risky the projects are. We'll talk about this in a second. What types of capital do firms use? First of all, let's make sure that we understand that capital comes from investors. So we're talking about long-term debt, we're talking about after-tax debt, and in case there's any permanent short-term debt, but this is not something that we need to worry too much at this point. But what I want you to know is that accounts payables accruals are not included. The other source of capital would be from preferred stock, which is some kind of a hybrid, and also from common equity. When we're looking at the cost, we want to make sure that we're thinking about marginal cost, or the cost of new debt, not the cost of what the loan was for your car, but what the loan would be for a new car that you're going to buy tomorrow. We're not interested in historical costs. We're talking about the cost of a new project that we're going to undertake. How do we calculate the components? Well, let's start with the cost of debt. The cost of debt, RD, should be an old friend of yours. This is nothing but the yield to maturity or the yield to call on a bond that the company has. So let's talk about 4 different methods of calculating this. One of them would be to ask an investment banker or a survey of bankers about what the coupon rate would be on new debt, because remember, we're talking about new debt, not existing ones, and the company doesn't have one. Another method would be to find the rating risk for the company or the project that we're interested on, and then take a look at what similar bonds are yielding. A third method would be to find directly the RD if the company has debt, or a fourth method, if there's only loans, well, would be to find out what rate on the new loan would be if a company were to borrow money from a bank. Loans in general typically more expensive, so banks are likely to be more costly for companies as opposed to bonds. The cost for preferred stock come from this green formula that we have here, which is the dividend of a preferred stock over the price of the preferred stock, and this F here refers to the flotation cost that we're going to talk about in the next couple of slides. This formula should not be a surprise for you, because it's basically the formula that we have for the dividend growth model, in which the price of a company depends on the dividend divided by R minus G, and in this case there's going to be no G, because the preferred dividend is a dividend that doesn't grow over time, so G would be 0. So here's some place where you can find more information about preferred stock. Preferred stock is a kind of a hybrid security, a mix between a bond and a stock. I will leave this slide here so you can pause the video and take a look at the definition. When a company issues new common stock, they have to pay flotation costs to the underwriters, and the underwriters are the investment banks. So for preferred or for new stock, we're going to have to consider this. And these flotation costs are going to depend, well, on how much money we're raising, what kind of company it is, and what kind of project it is. So for Coca-Cola, it may be very easy to go to JP Morgan and ask for help on issuing debt. For a startup, this may be more expensive, and it may require a bigger flotation cost. Flotation costs are very high for common equity, but for calculations, it's very easy to put them in and put them out. Depending on the company, we'll consider them more or not. A couple of questions that you should think about is that, is preferred stock more or less risky to investors than debt? preferred stock is more risky, but companies are not obligated to pay this preferred dividend, as opposed to a bond in which the companies have to. However, as it says here, companies typically or all the time was going to try to pay this preferred dividend, otherwise it could be consequences. Which one would be higher, the return on preferred or the return on regular debt? Here's some kind of a tricky thing, because corporations can actually deduct up to 70% of the preferred dividends. So we have this issue here that the before tax yield and the on debt and preferred are one thing, but the after tax yield to investors and the after tax cost to the issuer are higher on preferred than on debt. So the after tax is consistent with the fact that there's more risk for preferred stock. Now, why should be a cost for reinvesting our own money? If we had the cash, what should we pay for that? Well, we need to consider that these earnings can be reinvested or paid out to the owners of the company as dividends. Investors can buy anything from ice cream to other securities and earning a return, and this return would be, well, maybe RS. The firm could also purchase its own stock and making RS. So just as an intro here, there's always going to be an opportunity cost for return earnings. So what would be the cost of return earnings or the cost of common equity? Well, there are three methods to calculate: the CAPM, which we have seen, the discounted cash flow method, or a third method that I put here in red because this is a very judgmental or approximation method, in which in the third method we're just going to calculate a premium, an extra that investors will like to get on top of the RD or on top of the bond risk premium. If these three methods yield values that differ too much, well, maybe a good idea would be to calculate an average. Or if you're not sure about one method, maybe discard that method completely and make an average of the other two. What about the weights? Well, the weights are just the percentages of each of the components: how much debt, how much preferred, and how much equity as a part of the whole pie. If possible, always use the target weights, meaning the weights that we're going to have after the project, after the expansion, not the weights that we have right now. If we're borrowing money, a significant chunk of money, that means that this is going to have an impact on the capital structure of the company. So if you don't know the target, well, what can you do? At least try to use the current market values instead of the book values. And here's a note. Let's say that the stock price of a company goes up 10% in one day. Well, that means that the equity compared to debt ratio is going to have changed that very same day. So even though the dollar amount of debt has not changed, the percentage has changed, and you always want to use market values in case if you can estimate them. In our next video, we're going to talk a little bit more about the WACC. We're going to talk about factors that influence, adjustments for risk and foreign exchange, and some tips on estimating it.